Thank you, Mr. Chairman, and welcome to all of you. Good to have you join us. I want to go back to gain a little understanding of the unfunded liability, if we can. Mr. Durbin, you had shared with us that your 3-year investment earnings average was 8.8%, and I believe you just mentioned 12% in the most recent period.
That's correct.
Which is commendable. That's very strong. I'm looking at your funded percentage, which fell from 12/31/11, and it was at 65.3 to 12/31/12, 58%. So appreciating the comment you just made about it improving a bit here more recently, and I gather that's largely due to the collars that had been put in place and investment earnings. That's a pretty dramatic decline in that period when, looking at, you would have had decent earnings on investment. Can you help me to understand
Sure.
the gap there?
That's a really good question. The reason why we're seeing that ratio change this year so much is we're rolling in the last of the 2008 losses. We've been recognizing them in 5 valuations each year, 20%, 20% again. This is the last year that we have to recognize historic losses that were minus 28% in 1 year. We also have a difference in the amount of contributions that we should be receiving. It would be around 30% this year, very high number, and the Act 120 collars put it at around 11% for the contributions that we should have received for the previous year. That is booked more or less for us as a loss because we didn't get the contributions that were necessary to receive. So that's how we're accounting for that money. That's why we see that ratio dropping, but our posture is improving. As we made $3 billion in cash this year, we improved our fund ratio, and we added $1 billion above the 7.5. So on the one hand, we're accounting for our losses, and we're washing that through the system. And on the positive side, then we're actually making money. We had a good year, and we're aiming towards another good year this year.
I want to come back to that improvement, but before I do, your 5-year averaging, and I believe SERS operates under 10-year, you mentioned. That's stipulated by Government Standards Accounting Board. Is that GASB requirement?
No, the 5-year is just simply an average of the last 5 years of investment returns that we had.
So that's statutory guidance to you, or that's just a decision of your board?
No, that's just an internal number that we use to determine our progress.
Okay. Coming back to the collars for a minute, obviously we're looking at this proposal 2 years after we put through Act 120. Help us as a committee to understand, and the benefit of time was mentioned. What happens to the systems if we let things kind of move out for a period of time? We've put some reforms in place, frankly some significant reforms. Cut multipliers, vesting periods were adjusted, affecting legislators and state employees, all the rest. What will 120 do to us? I'll invite both of you gentlemen to respond to that. Over, let's go out 5 years. Are we in much better shape at that point?
I think that you are. I'd like to, if you don't mind, I'll take the first shot at this. Act 120 was major pension reform. There's no question about that in our view. We've just crossed over our 11,000th member under Act 120. So over 10% of our population is already in the Act 120 category. Of those, 9% of those members chose the increased benefits that they are paying for fully on their own. So we're seeing what we refer to as Class A4. We're seeing an increase in those numbers of individuals as well. The benefits for post-Act 120 were more than half cut from the previous bill itself. So from somewhere in the 9s, we went down to about 4 for new costs. So every time we're enrolling a new member, it's a cheaper individual to enroll into the plan than the previous plan would have provided for. So I've made some significant changes. I would also just mention, if I could, that in Act 120, you put in the shared risk proposal. The shared risk is a particular provision that allows for, if the investments don't work in the plan up to our assumptions over time, the employee contributions can rise. So I know that the risk gets a lot of discussion here, but you've already made an accommodation for that in the plan under Act 120, that there can be modifications to employee contributions if the funds underfund for a period of time, or underperform, I should say. I hope I answered your question.
Yeah,
Mr. Klein?
and I would agree with what Dave said. On the case of the PSERS side, that the changes made by Act 120 basically cut the cost of benefits by over 70% for in our situation, because on the SERS side, they have different tiers of benefit. We basically have one tier of benefit for our members. And again, over time, it is going to effectuate a reduction of the unfunded liability and bring us back to a better situation. The issue is there is still a ever-increasing employer contribution taking place here, which provides fiscal issues for both the state and the school districts.
And the final question, if I may, relates to, I guess, risk profile. Coming off of 2008, I think everyone was concerned about exposure of the asset base and very volatile environment. It's typical of institutions the pendulum swings the other way, and we get very, very conservative in our investment, our willingness to take on risk to gain that reward. Can you just talk to us about that fact pattern with the two boards, how you stand at this point, and what your vision of the future markets will be?
It's a loaded question. Right now, the SERS portfolio has about 80% of its assets in equity or equity-like investments. About 20%, 17% is in fixed income, 3% is in cash. Our professional judgment is that the biggest risk facing the fund from an investment standpoint is a rise in interest rates, because interest rates are so low that the return on fixed income is well below what our actuarial return target is. So the only way that we can really achieve that return target is by having a significant allocation towards equities, which is what we do have. So we feel that we're well positioned to meet our return target. We're in that position because we have a fairly significant exposure to equities compared to fixed income assets.
I think investment boards prior to 2008 were pretty much concentrated on the investment return. Post 2008, boards became much more concerned about the risk profile of the fund. So our board has given us the mandate to reduce the risk exposure of the fund, and we've been doing that for the last number of years. We do a lot of stress testing given various market conditions, economic scenarios. And the simple fact of life is we are in a negative cash flow situation. We're paying out $5.7 billion a year in pension benefits. We're taking about $2 billion in from external sources. So if we run into another 2008, given that we are in a negative cash flow situation, it's a double whammy. So we are very, very cognizant of our risk profile, and we concentrate a lot on our standard deviation. And every quarter, our investment consultant comes in and tells us how much risk we've taken out of the fund. So when we look at our returns, it's on a risk-adjusted rate of return, how much risk we're taking for each unit of return.
I appreciate those answers, and the one question that I did not ask was of the PSERS side, your rates of return. I picked up the 3-year and the most recent period. Could you share those percentages with us?
Yes, sir. For the 1-year period ending 12/31, we're up 11.39%. For the 3 years, we're up 9.9%. For our 10-year period, we're up 8.45%. Looking longer term, for 25 years, we were up 8.91% compounded annually, and for the 30-year period, up 9.49%. In every instance, we outperformed the assumed rate of return of 7.5%.
Well, those are very impressive numbers, and I appreciate your answers. Thank you, Mr. Chairman.